And to our live viewers, if you have any questions for Jason, please feel free to put them in the chat box, and time permitting, we will get to those at the end of his presentation. And with that said, Jason, I'll be right here if you need anything, and the floor is all yours.
Great, thank you. Okay, hello everyone. Thanks for being here. My name is Jason Levitt. I'm the founder and head of research at levittbrothers.com, which is a boutique research company that provides market analysis and trading ideas to the financial community. You can see my contact info here on the screen, along with my Twitter handle if you want to reach out with comments or questions that I don't get to here. I am also the creator of a masterclass in trading, which I'll briefly talk about at the end, as well as an audio course titled Guidelines to Successful Trading. All right, in this relatively short presentation, I'm going to talk about the big picture. Okay, why? A lot of people often zoom in too close and they lose sight of where we are overall. Okay, they stare so close at the charts right in front of them, they don't realize where everything fits into the big picture. Everyone wants to know what's going on right now. Like, what's the Fed going to do? We have a meeting tomorrow. What's going to happen with inflation? They want to know what stocks are good buys right now. They want to know, detailed trading parameters and what indicators you use with all your setups. They want to know all the little details, but it helps once in a while to stand back and consider the big picture. Okay, the 2022 bear market is a good example. I was telling subscribers at Levitt Brothers that on the other side of the bear market, generational money would be made. That if they could just stick it out until a bottom was put in place, there would be hundreds of phenomenal trading opportunities and the chance to make huge profits. But if you were thinking a top was in place and that we'd have another 50% correction, instead of getting excited about opportunities, you'd probably be depressed thinking, there was no money to be made, in that time period, or maybe for the foreseeable future. Or if you just thought we were in a bear market that was going to persist for a long time, you probably would have missed the turn, because every single bounce would have, in your eyes, would have just been a bounce within a downtrend, and you would have missed the turn and probably missed a lot of the upside on the other side. Okay, so it takes backing up and looking at the big picture to put things in perspective. So this is what I'm going to talk about today. I'm going to view the 100-year chart and talk about the cycles that take place, and I'm going to talk about why they take place. And then I'll offer my opinion as to where we are in the grand scheme of things. Then I'll zoom in to the intermediate term, where I'm looking out 12, 18 months or so, and I'll point to some studies that guide us over that time period. All right, so let's kind of get into this now. All right, here is the S&P 500 100-year chart. So one thing I want to point out, all right, so what I'm going to point out here is what should be kind of obvious, but not really, is that there's a tendency for the market to rally for 15, 20, 25 years and then consolidate for 10, 15 years or so. And then we get these big rallies that last 15, 20, 25 years, and then we get these consolidation patterns. They look like consolidation patterns when you view the big picture like this. This is the log chart going back 100 years. When in fact some of those are big drops, and then we get a rally after that. Okay, so that has been history, and you can even go back to go back to this is the Great Depression. The market went up a little too high and a little too low, but once it settled in, it actually had a consolidation pattern that went for 15 years or so. So the question is why? Why do we have these periods where we have expansion for 15, 20, 25 years, and then consolidation for another 10 or 15 years, okay? And within these time periods, there are counter moves, okay? So for example, this is the early 80s to 2000 bull market, one of the greatest bull markets in history. But we had, Black Monday over here. We had a recession here in the early 90s. There was a little recession here in 95, if you can believe it or not. And then this little red candle over here was Asian financial crisis, long-term capital management, fiasco, Russian ruble, crisis there. So you have big bull markets that last a long time, and within the bull market you have dips, corrections, and miniature bear markets. In the flat periods, same thing. You have a flat period here. But within this is the dot-com bubble here. there are several periods in here. There's a big candle there. There's a green candle there. There's another one there. There are definitely some like 10, 15, 20% bounces. And of course, this right here is a huge bounce where the market doubled. So even within a 10, 15-year consolidation pattern, there's going to be some big bounces, some big tradable bounces that you can make money with, and some big rallies that last more than a year. So the question is why? Okay, why do we have these boom bust cycles going back 100 years? It's not just like a recent phenomenon. It's like this is what takes place. This is what has taken place for basically the history of the U.S. Okay, and the question is why? The answer is, and this is going to be a simplified answer. It could be more detailed than this, and there's a little bit more to it than this. But this is generally speaking, the reason why is because a technology is created or invented or something like that, and then an entire ecosystem is built up around it. So we're not talking about a one-off technology where just something kind of comes, everyone kind of jumps at it, and then it's gone 6 months later, 12 months later. We're talking about like a generational technology that completely changes the way we live, the way we play, just the way we live. And then when the ecosystem is built up around it, that plays out over the course of 10, 15, 20 years. But we tend to overbuild it. And when we overbuild it, that's what leads to the consolidation patterns. Okay, so instead of having like 2 steps forward, 1 step back, 2 steps forward, 1 step back. So if you look at this, you'd think, why can't we just, move up a little bit, dip, move up a little bit, dip, move up a little bit, dip, move up a little bit, dip. Why can't we do that? Why do we rally for 20 years and then go sideways with some big downturns that last 10 or 15 years? And it's because of this, it's this boom bust cycle between a technology being created, an ecosystem being built up around that technology, and that lasts 10 or 15 or 20 years, and then we have to kind of cut the dead weight and go on from there. So let me give you an example here. So let's go back to the early 1900s. The car is, I don't want to say it's invented or created, but the car is created, okay? And then what happens is an entire ecosystem is built up around the car to support the car, okay? So for example, factories need to be built. Factories are not small projects. They're big construction projects that take a couple of years. They require a lot of material, a lot of labor, a lot of time. Okay, so again, this is not a one-off event where some fashionable thing comes and goes. It takes time. Okay, then you have raw materials that go into the car: steel, iron, aluminum, rubber, plastic, and dozens and dozens of others, okay? And those raw materials have vendors that come from within the United States and outside the United States. So again, it's a big process. It's not going to come and go in 6 months. It's going to take years, and in this case, decades to play out. You have labor. How many people work in a car manufacturing facility at least years ago before there was a whole lot of robots? There's like hundreds, maybe 1,000. Those people need to live in houses. They need to eat food. There are going to be schools built. There's going to be police. There's going to be fire. Entire towns are built up around the fact that a car manufacturing facility is built. This is why you get a 20-year bull market, is because a car comes along and then you have this entire ecosystem is built up around it. You have research. A car isn't going to stay the same. Okay, there's going to be competition eventually. Everyone's going to be trying to do better than the next guy. Okay, so that's more money, more employees. You have maintenance shops. Not initially, but eventually there's going to be maintenance shops to fix the cars. Okay, so that's more, that's a secondary effect that people have cars, and then eventually they're going to need a place to get their cars fixed. So there's more businesses that are opening up. Insurance, not initially, but eventually insurance is going to be offered to insure your car. Then we get something that's really interesting, and I put roads and gas stations, is that there's some sort of feedback mechanism. Okay, when the car first comes along, there's not a whole lot of incentive to get involved in the car industry because there's nowhere to fill it up with gas, and there's not a whole lot of roads. But as more and more people get cars, more roads are built, and then more and more people are saying, hey, demand for cars is going up because there are roads, to drive on, so I'm going to get involved. So then you get, as more roads are built and more gas stations are put in place, there's a feedback loop that more and more people want to get involved in this industry. Now, I could replace cars with a lot of major technologies. I could replace it with radio, and it's a very similar ecosystem. You have factories to build them, you have raw materials, you have labor, you have research, you have programming on those radios. Eventually you have advertising on those radios. You have retail stores to sell those radios, okay? A technology comes along and an entire ecosystem is built up around it to support it, okay? And again, it's not fly by night. It takes a couple of decades to fully play out. This is why we have these big bull markets. I could replace radio with TV. It's exactly the same thing. I could replace car with PC, and it's the same thing. Okay? At first, not a whole lot of incentive to get involved in PCs because they don't have much capability. They're not very fast. The software is limited, but as more people use them, more companies get involved. Somebody wants to make a chip that makes it go faster. Somebody wants to make the peripheral stuff like the mouse and the keyboard. Software companies pop up to support it, okay? And, it takes labor, it takes research. There's going to be some shops to fix. And as more and more people get PCs, it feeds back on itself. Then there's more incentive for others to get involved. I could replace car with internet. Okay, go back to the mid 90s. It's the same thing. Okay, a technology gets created, and then an entire ecosystem is built up around it to support that technology. Last one, I could put smartphone in here. Pretty major thing over the last 15 years. Smartphones come along. At first, they were pretty simple, but now they're miniature computers in your hand. There are companies that have been created that are essentially smartphone hosted businesses. Yes, they have a website that complements it, but they pretty much only exist because a smartphone exists. If a smartphone went away, the companies would go away. So a smartphone gets created, factories, research, thousands and thousands of people. You get app developers, and of course you need the broadband to send messages, to send pictures, to send all this stuff. Podcasting, video stuff, like all this stuff, like an entire ecosystem gets built up in order to support the phone. And the more that infrastructure that gets built up, the more incentive there is for people to get involved in the business. This is why we have 20, 25-year bull markets, because major technologies get created and then entire ecosystems get built up. And then when the infrastructure gets bigger and bigger, there's more incentive for other people to get involved. Okay? So here's back to the quarterly chart. Not the quarterly chart. Yeah, this is the quarterly chart. This is the 100-year chart. So, but not the problem, okay? It's not a problem. But to answer the question of like, why do we need a bear market that lasts 10 or 15 years after a bull market? We know why the bull markets take place. It's because these technologies take hold, and then these ecosystems are built up around them, and that takes a couple of decades to play out. But why do we have to have a 10 or 15-year bear market coming after the bull market? The reason why is because we overdo things. Okay. We don't just assign the task of making a car to one or two or three companies. Okay. That's not the way things work. Anyone could pursue it. Anyone could chase the dream. Okay, so this graphic here, with the car in the middle, there isn't just one of these. Okay, if the government came along and said there's going to be two companies, one of them's going to be in Michigan, one of them's going to be in Indiana, and that's all, then each one of those locations would have a miniature ecosystem, and that would be it, and we'd have some slow growth. But instead, the way things work in the U.S. is that anyone who wants to pursue it can pursue it, so we end up overbuilding. There isn't just one or two or three of these. There could be dozens of these or even hundreds. In 1920, there were 200 car manufacturers. Okay? We don't need 200 car factories. We didn't have enough people to support that. So the reason why we need the 10 to 15-year bear market after the bull market is because we way overdo it. Okay, so everyone chases the dream, but it's just simply not possible for everyone to succeed. Not everyone could win. Some businesses just need to go belly up. So there's going to be consolidation. There's going to be companies that just simply go out of business. Other companies will be bought or acquired for a fraction of their cost because they might have access to like technology or something. So an industry that starts out with dozens or hundreds of participants ends up becoming just a couple. Okay. So for example, a car in 1920, I said there were 200 car manufacturers. Eventually got down to 3, Ford, Chrysler, and GM. Okay. With PCs, there were dozens of PC manufacturers in the early 80s. Go out to the late 90s, early 2000s, through consolidations, through bankruptcies and such, there were only a handful left. Okay, think of search engines in the second half of the 90s. There were dozens, okay, besides Google and, Internet Explorer. There were, Lycos and Excite and Ask You. There were dozens and dozens. Now we just have a couple. Okay, most industries are like this. Okay, maybe, like the restaurant industry doesn't do this. You could have a couple hundred restaurants. That's fine. But most industries follow this model where something gets created, an infrastructure gets built up around it. A lot of other people chase the dream. Too many people chase the dream. We overbuild, which is why we have these blow off tops at the end of the bull markets. And then we have to revert back and eventually, consolidate the run up, and that takes time. We start out with a lot. In the case of cars, it was 200, and then we end up with a little. In the case of cars, it was only 3. That's why we have these boom bust cycles. Okay. So the question now is, like, where are we today? So here we are. This is again, the 100-year chart of the S&P 500. Obviously, we are over here. I grabbed this a few days ago. And the question is, where are we in the big picture? Are we the equivalent of this? Okay. Now, I don't mean to circle the crash there. I'm just wondering, are we in the middle? Are we at the beginning stage? Are we like somewhere over here where we've had a nice run and we're probably in the later stages? That's the question, is like, where are we in the big picture? And so I'm going to offer you my opinion. So if it takes some sort of technology, like right here, if some sort of technology comes out and that technology fuels a bull market for 15 or 20 years, and there'll be other technologies. So like the PC really started gaining some momentum in the early 80s, and the internet started getting momentum in the mid 90s. There's going to be some overlapping technologies. The question is, there's 2 ways I'm going to answer the question is with regards to where are we in the big picture. One is historically, how far do these things go? And then two is there a technology that could propel us further? Okay, so historically, these rallies have lasted 20 years, give or take. Okay, it depends on where you measure from. A lot of people, if you go back to the Great Depression, a lot of people don't consider the bull market starting until here. I disagree with that, because other than like the first couple of years, I view this as just a big consolidation pattern. And then the bull market to me just started here in the late 40s. Okay, let me get a drink here. Okay, and then this bull market lasted for 20-ish years, from basically 1950 until the late 60s. So about 18, 19 years. The bull market over here in the early 80s, we broke out. We come to start out in 1980. It moves up, comes back down and tests, and it lasts all the way until 2000. So that was like an 18 to 20 year bull market. So if we measure the current bull market, if we measure from the 2009 low and we go out 20 years, that gets us to 2029. If we measure from, once things really started moving here, 2012, 2013, then that pushes us out a little bit further. Okay. Some people will measure from 2013 when we officially made a new high. Wherever your starting point, as long as you're consistent, I think it measures out to the late 20s and early 30s. Okay, if we're measuring 20 years from the low, we're talking about 2028, 29. If we're measuring 15, same thing. If we measure 15 years from the 2013 breakout here, it measures to 28, 29. If we're going 20 years from the breakout here, that gets us to 2033. So all measurements take us out to that range of 2028 to 2033. So that is the big picture. If the current rally matches previous rallies, the first one, not the first one, but the one that followed the Great Depression and the one that followed the 70s inflation situation, and that sideways movement, it puts us out to like 2020, 28 to 33 range. And considering it's only about to be 2024, it's possible that we have 5 to 10 years left in the current bull market. It doesn't mean we're going to go straight there. There's going to be interruptions and stuff along the way. But it's entirely possible that we are only 10 to 15 years into this and that we still could have another 5 to 10 years left. That's what I'm thinking. Again, with some interruptions, with some disruptions along the way. We had a bear market in 2022. We're going to have another one or two along the way, but it's entirely possible that we have another 5 to 10 years left in this bull market. But the next question is do we have a technology that could carry us? Okay. Smartphones, I'm going to say, is not done, but I would say their hyper growth is done. Okay. There's going to still be growth. There's still going to be app companies come along, more apps. Companies that find their home on a smartphone are going to get bigger and better, but that's not hyper growth. That's not going to fuel a 10-year bull market. Maybe AI. Okay. AI is just got really big just in the last 6 months, and there's certainly a possibility that it could get a lot bigger. Okay. So I would say the combination of us being possibly, with 5 to 10 years left, and AI is a big enough technology that it can carry us, I think the stage is set that we could, go until at least the end of this decade. Okay. So that's my big picture. If the current situation matches what's happened in the past based on length of bull markets plus the needed technology plus the ecosystem that gets built up around it that's needed in order to fuel it, then I would say we could have another 5 or 10 years with some interruptions along the way. All right, let me now zoom in and get an idea of what we're looking at for the next 6 to 12 months or so. All right, so I'm going to show you a couple studies that have been done just to kind of give you an idea. All right, so I don't know if this is going to be readable, so you'll have to bear with me and I'll just explain it. So listed here are all the corrections. A correction is a 10% drop. It's a 10% drop. These are all the corrections from 1980 until 2020. So about a 40-year period. And you can see this column here has all the corrections. It's all red. The average correction is 18.8%. This next column here is what the market was doing a year later. 1 year after the correction, the market was up 90% of the time with an average gain of 23%. Okay, the only red here is here, and here. The only red is during the dot-com bubble era and the financial crisis. Okay, so unless something's horribly wrong, there's a pretty good chance we're going to be up a year from now. Now, that's right now, okay, because the bottom, the market corrected in 2022. The bottom was in October. So we just satisfied this column here, okay? We were up quite a bit. But this next column is kind of exciting, is that this is the gain of the market looking out 2 years. Okay, so the market doesn't do well just for 1 year after a correction. It does well for 2 years. You look at this column, the market is up most of the time. The only red here is during the dot-com bubble bursting and during the financial crisis. And the gain here is about 37%. Okay, corrections do well for not just a year, but 2 years. We're about 13 months after the correction low. So this tells us that, there are high odds that the market will be doing well another 11 months from now, basically going into the election for next year. All right, next study. Since 1950, when the S&P has posted a 5-month win streak, it was higher 1 year later, 25 out of 26 times. Okay, so last summer, here's your 5-month win streak. Okay, when this has happened, find the high, not the high there, but find the high there, or find the close there, and there are very high odds that, the market will be doing well another 11 months from now, basically going into the election for next year. All right, next study. Since 1950, when the S&P has posted a 5-month win streak, it was higher 1 year later, 25 out of 26 times. Okay, so last summer, here's your 5-month win streak. Okay, when this has happened, find the high there, or find the close there, that 12 months later it's going to be higher. Okay, so that bodes well for the future. It doesn't tell us anything about next month or next quarter, but it just tells us when you have a 5-month winning streak, 12 months later there are very high odds that the market's going to be higher. Okay, next study. This one's a little bit of a mouthful. Over the last 45 years, when the Russell 2000 has followed a 52-week low with its best 4-day gain in 3 months, the index was up 6 and 12 months later, 83 and 100% of the time, with median gains of 17% and 26%. So let me explain. When the Russell 2000 drops to a 52-week low and then follows it up right here, it's not that hard to see, and follows it up with its best 4-day rally in 3 months, 6 months later, the Russell was up 83% of the time with an average gain of 16.5%, and 12 months later, it was up 100% of the time with a 25.6% gain. Okay, so that tells us, like, from the close right here, there are very high odds that 6 months later and 12 months later that the Russell is not only going to be up, but up pretty big. Okay, so that puts us out to, like, and this just happened at the beginning of November, so that puts us out to next spring, and then puts us out to the next, November, right in time for the election. Next study. Over the last 30 years, when the S&P has had 4 unfilled gaps that were greater than 0.5% within a 3-week period, the index was up 100% of the time, 6 and 12 months later, with a median gain of 11 and 13.9%. Okay, so that's gap number 1, there's gap number 2, gap number 3, gap number 4. 4 unfilled gaps of 0.5% or more within a 3-week period, and the S&P was up 100% of the time, 6 months later and 12 months later, with an average gain of 11 and 14%. So there's your close after the 4th gap, pointing out 6 months, pointing out 12 months. There are very high odds the market is higher. Okay. So let me do one more here, and then I'll wrap up. All right, so here is looking at the presidential cycle. This is the Dow over the presidential cycle. Right now we are in December of year 3, so we're right here, which is this big blue one. Historically, the market has struggled a little bit going forward, okay? But then obviously, as you can see, it does very, very well. So if I were to recap everything here, I would say when you look at the 100-year cycles and the tendency for these boom-bust cycles, it's possible that we're only 10 or 15 years into a bull market and we still have another 5 or 10 years to go. And we do have a technology that can fuel us forward, which is AI. And then when you look at these closer studies with these unfilled gaps and the 1 and 2 year moves off of corrections and the Russell doing a 52-week low and then a big rally, a lot of things point towards the market doing well 6 to 12 months from now. Maybe there's a little bit of softness, early in 2024, maybe like February, March, something, but there are pretty good odds that the market's going to do well towards, at least second half of 2024 into the election. Okay, so I'm going to wrap up here. I appreciate the Money Show letting me speak here, so I'm going to do a little promo just of who, what I do, and then I'll wrap up. If you have any questions, comments, you can just email me. I don't think I'll have time to answer them here. So trading is part art and part science. Okay, it's part mechanical and part intangible. Okay, for the science and the mechanical part, I've created a masterclass. This is setups, charts, indicators, entries, exits, stops. Like it's the how-to stuff in trading. Okay, but knowing how to do something without the intangibles, you need the intangibles. Like it's kind of like if you took hitting lessons, but you need to know how to approach an at bat. Okay, so I have a masterclass in trading to deal with mechanical stuff, and I have a guidelines to successful trading is an audio class that deals with the intangibles. Okay, if you want more information, you can go to my website, levittbrothers.com. Right here it says courses. You can just click on that, and there's a couple videos there that just give you a general overview. And with that, I'll say thanks to the Money Show for letting me speak, and I will throw it back over to them.
Great. Thank you very much, Jason, for your great presentation. Excuse me. Thank you all for joining us, and stay tuned if we have a lot of more exciting presentations headed your way. And again, Jason, thank you, and we look forward to seeing you again.
Great. Thank you.